All right. Welcome to episode 28 of The Rent Roll, your podcast on all things rental housing, apartments, SFR, BTR. I'm your host, Jay Parsons. And, we're in the spring. It's conference season, travel season, investor summits, all of those things. I was at a great one last week. We celebrated the 25th anniversary of Apartment Life. If you're not familiar with Apartment Life, what a great organization that is. So much focus today on resident care and retention. And Apartment Life has been on the front end of this for 25 years, really loving and caring on the people who live in apartments, especially when our leasing teams are just so spread thin. Having the Apartment Life teams playing part of that role can make a huge difference. There's a great study that Ron Whitten did showing the relationship between friendships and retention. And basically common sense, but the data backing it up, saying the more friendships you have in a community, the more people you know, the more likely you are to renew your lease. And unfortunately, a lot of people just don't know anybody in the apartment complexes they live in. And Apartment Life is a great organization that helps impact that. So congratulations to the Apartment Life team, 25 great years. And it was an honor to see several hundred of my friends at that event in Dallas last week, including many of you watching this program. So thank you for everybody who supports Apartment Life. Lots to cover today. We're talking about the Southeast, okay? Lots going on in the Southeast. Everybody knows the Southeast. We're talking about the investment case for the Southeast, okay? Everybody knows there's a lot of supply going on, of course. But what's the long-term case for Southeast apartments, and talk a little about SFR as well. And then to further the conversation in the Southeast, we'll be bringing in my friend James Kane, formerly a managing director at Starwood. He was the lead asset manager for more than 85,000 apartment units in Starwood's national multifamily portfolio, including a ton of it in the Southeast. So he's a guy who knows that area well, based in Atlanta. Also helped lead the disposition of over $12 billion of multifamily assets during his time at Starwood as well. And now a partner and head of Southeast acquisitions at Madera Residential. So really excited to welcome in James. We'll be talking the Southeast and broader multifamily topics as well. All right. So before we dive in, a shout out to our sponsors. First of all, to Madera Residential, leading operator in Texas, and also to JPI. One of the top apartment developers in Texas and Southern California, and now some other places as well. All right, as always, kick it off with, here's a chart. And so talking about the Southeast today, I got a few things I want to share with you verbally for those listening, and got the visuals for those who are watching the video here. The first one shows, the headline here is, the Southeast is winning an increasing share of apartment sales dollars. And so when we look at the total pie of apartment sales, and we go back last 15 years, from the end of the middle of the Great Financial Crisis to where we are today, we've seen the average of all the dollars spent on apartments on a trailing 12-month basis. If you go back 15 years ago, that number was under 20%. Even in the early 2010s, we were, I think, got a little about 15, 16%. So hovered in that, let's call it 15 to 20% range for most of the first half of the 2010s decade. Second half of 2010s decade, got into that low 20%. And then we get into the 2020s. And after COVID, we jumped up to 30%. It was steadily increasing that whole time. Went from, again, high teens to low 20s, mid 20s. Then we got up all the way up to 30. And now we're settling back in the kind of mid 20% range. So, and so this is just, by the way, looking at Florida, Georgia, Alabama, Tennessee, North Carolina, and South Carolina. So a narrow definition of the Southeast. You could argue for some other states. I'm just focusing on those states for the purposes of this. And now when we look at more specifically here, there's 14 MSAs in these states that rank in the nation's top 50 for apartment sales this decade. Okay. So again, just a handful of states that I mentioned. Atlanta, I'm going to look at, I should define this a little bit. These are the top markets in terms of total apartment sales and in terms of dollars so far this decade, the 2020s. And I'm going to compare it to where it was in the 2010s decade. Okay. Atlanta ranks number 2 this decade. It's up 2 spots. Orlando ranks number 10, up 3 spots. Charlotte ranks 12, up 8 spots. Tampa and Raleigh ranked 15th and 17th, unchanged. Nashville, 19th, up 12 spots. Miami, ranked number 20, up 13 spots. Fort Lauderdale's up 7 to 23. Jacksonville's up 5 to 31. West Palm's up 1 to 33. Charleston, South Carolina, not even among the top 50 on size, but ranks 39th for apartment sales activity this decade, up 9 spots. Sarasota, Bradenton, up 11 spots, number 44. Greensboro, Winston-Salem, North Carolina, up 5 spots, number 45. And Greenville, South Carolina, 46th. Up. That one's actually down 1 spot, interestingly enough. So there you go, 14 markets ranking in the top 50 in terms of apartment sales activity. And then if we went to the top 100, we have 20 more in there. Savannah, Fort Myers, Memphis, Knoxville, Birmingham, Columbia, Tallahassee, Palm Bay, Melbourne area, Wilmington, North Carolina, Huntsville, Alabama. Huntsville was up 37 spots from the 2010s. And so we think about, a lot of people think, you look at those sales dollars numbers, kind of reflects, I think, the motion of capital, thinking, this is the Southeast, and the Southwest, COVID boom, drawn more demand into it, temporary phenomena maybe, but not really. I would look at rent growth, and we're going to look at this in 3 buckets. Average rent growth in the primary 10 Southeast markets, the Big 10 Southeast markets. That's, Nashville, Charlotte, Raleigh, Atlanta, and then, of course, the Florida markets, the 3 South Florida markets, plus Jacksonville, Tampa, and Orlando. And for the 2015 and 2019 timeframe, those 10 markets averaged 4.2% rent growth. That compares to U.S. average 3.5%. So outperformance is 70 bips. Now let's look at the COVID era and an inflation boom, 2020 to 2022. This is the period everybody looks at the most, 10.1%. In the Southeast 10 markets versus 6.3% nationally. So obviously that's the big outperformance. Currently, 2023 to present, the big supply boom, big demand, but also tons of supply. The primary Southeast 10 markets are down 1.1% compared to the U.S. average of plus 1%. But the really think about, okay, if we know supply is going down, which it is, fewer starts, then I think the pre-COVID era, not the COVID era, obviously, but the pre-COVID era, is a reasonable benchmark. And even in that period, I think people forget, like even in the 2010s decade, especially kind of the mid to late part of the decade, these markets did very well. They're outperforming markets. We could say the same thing about Texas and some other Sunbelt markets as well. These are outperforming markets. So again, the Southeast, 4.2 to 3.5, so outperformance of 70 bips in the pre-COVID period from 2015 to 2019. So I think we're going to get back to something more like that with high demand and lesser supply, maybe in a wider gap if the supply numbers remain especially low. Now, speaking of supply, I think the current supply cycle has really kind of skewed our sense of reality. I mean, for as long as all of us have been in this industry, people have been screaming, especially from Wall Street, about oversupply in the South and the Southeast. Okay. But really, that hasn't actually been true. I don't even like the word oversupply to begin with, but even high supply, relative demand hasn't really been true until this cycle, until 23, 24, 25. If you go back, to the 2010s decade, we never really saw a lot of supply. Now, again, there are submarkets that are exceptions, but generally speaking, across this region, we just didn't see that much supply. Across the Southeast, we did not see this inventory growth rate, just completions divided by existing stock, top 3% until the 2020s. Okay, it was below 3%. Again, we had some high supplied submarkets. For the most part, though, the markets were not that high supplied. It was above the U.S. average, and sometimes more makes us think, oh, there's more in these markets, therefore it's a lot. But more does not equal a lot. Okay, so we should not confuse those two things. Now, what we're seeing is truly what a lot of supply means. That's where we are right now. We're peaking on supply last half of this year, last half of last year, first part of this year, and those numbers are rapidly coming down. And so now we're about 5% inventory expansion in the Southeast. That number is going to quickly drop below 3%, and by 26, maybe early 27, will be below 2%, according to the latest forecast. So still more supply in these markets relative to elsewhere, but also more demand. And so that's what really matters, supply relative to demand. And that's what we get into this next part here. The Southeast is home to 16 of the nation's 22 fastest growing apart markets in terms of net absorption. We look at net absorption since the COVID period hit in March of 2020. 16 of the top 22 markets are located in the Southeast, led by, and I'm going to do this on a growth basis, not a raw absolute number. So Huntsville, Alabama, we've added 15,000 plus occupied apartment units, up 50%. I won't read all these numbers here, but number 2 is Lakeland, Florida. Also in the top 10, Wilmington, North Carolina, Myrtle Beach, South Carolina, Savannah, Georgia, Charleston, South Carolina, all in the top 10, all above 29% expansion in terms of number of occupied apartment units. And this next group, you see a lot of these larger Southeast markets and some mid-sized ones. 11th nationally is Nashville, up 26.8%, Charlotte, up 25%, Fort Myers, Raleigh, Durham, Jacksonville, Sarasota, Bradenton, Palm Bay, Melbourne, Daytona Beach, Florida, all up around 20% or more. And then Asheville, North Carolina, 21st, up 19%. Port St. Lucie, Florida, up 18% in terms of number of occupied units. So a ton of demand. And yeah, obviously the COVID period, the accelerated migration of the Sun Belt played a role. But again, that's not I think we need to be careful about confusing the moderation of demand to a real slowdown. And really what we're seeing is a moderation in demand now. So while a lot of that number is driven by the earlier part of the decade, there's good reason to expect we'll continue to see outperformance of demand in these markets and in other Sunbelt markets. So next chart here, looming slowdown in population growth is lesser factor in Southeast. So one of the things you hear about all the time is, hey, population growth is slowing down nationally, especially the Sunbelt, therefore trouble. Well, let's look at year-over-year population change in the Southeast relative to the rest of the U.S., okay? In the Southeast states have been highlighting, we've been at 1 to 1.4% population growth since 2010. Okay. And it's gotten as high as almost 1.4%. You look at the forecast from Oxford Economics, that number it kind of hovers around 0.8%. And I, by the way, I said 1 to 1.4, actually it's 0.9% to 1.4%. So now it's going to get to about, let's call it 0.8%, maybe a tick below that. It is a little bit of a drop off. I don't want to downplay it too much, but it's not that big. I mean, those are, for populations this big, that's still a pretty healthy clip. You look at nationally, though, we were seeing the population grow about 0.8% in the first half of the 2010s decade. It slowed to about half of that, and the forecast is about 0.4% over these next 5+ really the next decade from Oxford Economics. So the relative slowdown in population growth is much more pronounced outside the Sun Belt than in it. And not only population growth, but specifically when we drill down into the younger adult population that's more likely to be renters, especially of apartments, but even of single-family homes as well. Let's look at just the population in their 20s and 30s, and let's look at the forecast for 20 and 30-something population growth over the next decade from Oxford Economics. Okay, so 6 Southeast states combine to account for 55% of the nation's projected growth in 20 to 30 somethings over the next decade. Florida is number 2 in the country, 500 million. Then we got, 500,000, not 500 million, sorry. North Carolina, Georgia, Tennessee, South Carolina, and Alabama. All ranking in, South Carolina all ranking in the top 10. Alabama's ranked number 14th. And so number 1 is Texas, 954. And then everywhere else is again in that top 10 in the Southeast, with the exception of Alabama at number 14. So Texas, Arizona, Utah, Colorado, and Washington State are the only ones that are not in the Southeast that also rank in the top 10. So that's where demand's going to continue to go. And the view of Oxford Economics, I certainly share that view as well. So the jobs are going. Yes, the cost of living has gone up, but it's still relatively cheaper, significantly cheaper relative to other parts of the country, especially to the coast, with the exception of maybe the Midwest has an affordability advantage as well. But the Midwest and the Sun Belt still have a strong affordability advantage, still have jobs, still have younger adult populations, and all of those things will favor apartment and SFR demand. All right, so let's talk about SFR for a minute. Here's a map from John Burns showing the SFR REIT portfolio concentrations. And what it shows you is that the REITs love the Southeast too. And they've been bullish on the growth in the Southeast for a long time. They remain bullish on it continuing. When you add up the homes owned by American Homes for Rent and Invitation Homes, about half of their combined SFR portfolios nationally are concentrated in just 5 Southeast states: Tennessee, North Carolina, South Carolina, Georgia, and Florida. And that's pretty remarkable. At a metro level, it's led by Atlanta with a combined 18,000 plus units in the metro area, 12,000 plus units in Tampa, nearly 9,000 units in Charlotte. But in addition to all the big MSAs, the REITs also have presence in some smaller and fast-growing Southeast markets like Savannah, Hilton Head, Charleston, Greensboro, and Winston-Salem. And when, typically one of the long-term knocks on the Sun Belt has been, hey, it's cheaper. It's the homes are cheap to buy. The discount to buy isn't that significant. People are always going to lead to buy homes. And if you listen to my podcast for a while, you know that I think that first and foremost, like every SFR and apartment investor should be cheering for a healthy for-sale housing market. You want to see more people leaving to buy homes because that's a sign of a vibrant economy. There's more household formation. Those units will get backfilled faster, typically in a stronger for-sale housing market, and often at a higher rent. So that's something to be scared of, first and foremost. But also, reality of today is it's a higher retention environment because that jump is higher, even in these Sun Belt and Southeast markets. And so John Burns estimates the premium to own versus rent in the Southeast, in terms of average total all-in monthly costs, it ranges from about $700 to as much as about $1,100 in these different Southeast markets. So $676 in Atlanta at the low end. It's around $800 to $900 in Charlotte, Fort Lauderdale, Jacksonville, Tampa is $750, Nashville is about $1,000, and then between $1,000 and $1,100 in Miami, Orlando, Raleigh, Durham, and West Palm Beach. So that's a significant premium. Now, that said, we're not seeing big rent growth right now in the Southeast SFR, and the same is true in apartments. We're averaging, most of these markets are right around 1%, 2% range. Miami is the only exception, 6.5% SFR rent growth. Raleigh, Durham's actually slightly negative. Most of these markets are right around 1%. Why is that? Well, I've covered this in a prior episode, but it's not demand. There's still a lot of demand in these markets, but there is more supply. It's where home builders have been building. It's where we have seen more build-to-rent inventory being added, competing with SFR. And we see accidental landlords, quote-unquote accidental landlords, that are holding onto their homes for various reasons, choosing to rent it out instead of selling it. So supply is still playing a role in SFR, Southeast and Southwest. And that is compressing rent growth for the time being. But, BTR supply is coming down as well. And so just like apartments, that should go from a headwind to a tailwind for investors in the next couple of years. And it wouldn't surprise me to see those SFR rent growth numbers pop back up. Nothing like we saw in the peak of inflation, but still should see a healthy rebound if the economy remains in decent shape. All right, let's go into rental housing trivia. Today's question on the Southeast theme is, which Southeast market saw the highest average apartment rent growth over the last 10 years? I'm going to give you 5 choices: Charleston, Knoxville, Miami, Naples, or Nashville. Okay, Charleston, Knoxville, Miami, Naples, or Nashville. So cast your vote. We'll look at that in a minute. But first, in the news. All right, got 4 headlines for you this week. The first one comes from The Economist, and a great headline here. It says, if you can't find a place to rent, blame the government. Foolish crusades against landlords have made housing shortages worse. Here's a direct quote from the article. Many policies aimed at easing pressure in rental markets have been treating the symptoms of the problem rather than the cause. They have therefore ended up making things worse for the people they were meant to help. Very well stated. Can't add anything more to that or state it any better. Speaking of cities that have done an excellent job making things worse, of course, I shouldn't be so cynical. It's truly sadly made things worse. St. Paul, Minnesota. Headline from the Minnesota Star Tribune: amid pressure, St. Paul City Council considers weakening rent control. The council aims to exempt new buildings from the city's rent stabilization ordinance while pushing new tenant protections. All right, so remember a few years back, 2021, St. Paul passed a very strict rent control measure that capped rents at 3% on new leases and on renewals. And so since then, they've been trying to backpedal because some of the city leaders, not all, but led by the mayor, some have realized that it was a bad idea. And it's St. Paul took itself off the table for the nation's biggest construction boom in 50 years, therefore depriving its citizens and potential future citizens and its employers of potential workers because of its unwillingness to consider the evidence and the science of this topic, and instead choosing what sounded good over what's actually been proven to work. A real tragedy, unfortunately. And so it's built very little. And so now we see from the article, it says the proposal would exempt all new buildings from rent control forever. But council members aim to link the changes to a new slate of tenant protections, which developers and landlords have opposed. Quote, it's critical that as we amend rent stabilization, those protections are brought back, the council president said. First of all, rent stabilization is just rent control. Let's not anybody fool ourselves here. This article, just as a it's very sad what's happening in St. Paul. Even the coverage has never really taken a serious look at the science of this topic, despite the dozens and dozens of studies that have all shown the same thing. And the problem here, I think the people in St. Paul have to really understand is, like, once you get on this train, it's really hard to win back the trust of investors and developers. Because the problem is, what's to think, okay, let's say you unwind this a little bit. Well, what if there's another council election and the next council says, hey, actually, that was a bad idea. We want to go back. And especially you have council members actively pushing that view. It's bewildering to me still if some say, hey, let's just let time see how it plays out. No, you guys just missed the biggest construction boom in 50 years. And so if you can't see that, you need to go look around the country, talk to impartial observers, look at university studies and whatnot, and figure out what happened. And then adjust for that. But the problem here is, again, there's some tenant protections to be common sense, but if it comes with a bunch of you can unwind rent control, but if you have the equivalent of it through things like good cause eviction and overly stringent screening criteria and whatnot, limitation of criteria, I should say, you're really not going to solve the problem. So certainly hope that common sense comes back to St. Paul. Next headline comes from Interesting Engineering. America's housing crisis gets high-tech upgrade with 3D printed robot-built homes. From 3D printing to factory-built homes to using hemp, builders are exploring unconventional methods to construct homes. All right. So this is an interesting article about factory-built houses shrink-wrapped and shipped to sites. 3D printed homes using a computer-controlled robotic arm, a nozzle steadily layering lines of concrete, forming walls that can take shape quickly. Also has some interesting stuff about a trendy new building material called hempcrete, you may have heard of. I'll read a little bit from this. It says, hemp is combined with materials like mineral lime to create hempcrete, a natural insulation that is both mold and fire resistant and can serve as an outer wall, insulation, and inner wall all in one. While hempcrete still requires wooden studs for structural support, it replaces 3 separate wall building components with a single material. Unlike trees, which take years or even decades to mature, up to 1 million hemp plants can grow on a single acre within just a few months, making it a fast and sustainable alternative for construction. All right, so interesting stuff. We'll see if that takes off. All right, last headline. This one comes from the New York Post, and the headline is, a grand 10,000 unit apartment development has been unveiled in the world's most isolated nation. So North Korea. We were talking about the Southeast U.S. I had North Carolina on my mind. No, not North Carolina, a very different part of the world. North Korea is spotlighting a new residential development in its capital city as it emerges from a 5-year pandemic-induced isolation, with its leader overseeing a sprawling 10,000-unit apartment complex. State media released rare images of I'm reading from the article here. They released rare images of the Hermit Kingdom site on Saturday, showcasing sleek high-rises and a connecting sky bridge, part of a broader initiative to bolster housing in a nation long grappling with economic stagnation and widespread deprivation. The project, set to open officially on April 15th, coinciding with the birthday of the country's late founder, marks the third phase of a 2021 plan to construct 50,000 apartments by 2026 in the capital city. So there you have it. So kind of interesting. Did not expect to see a North Carolina, I did it again, goodness gracious, North Korea 10,000 unit apartment complex in my Google News feed last week, but there it is. So yeah, more supply. We need it everywhere, even in North Korea. All right, next up, new digs. All right, new digs when we highlight a cool new development. And as much as that one in North Korea is interesting, I think we should go stateside for this. And this one takes us to Providence, Rhode Island. It comes from a tip from a podcast listener, Ian Kennedy. So thanks for saying this one my way, Ian. From the Boston Globe, they profiled this one here. I got a picture on it for those of you looking at the video. Headline is Developer to Build Providence Art and Design Center with 150 apartments, 25 condos on former I-195 land. So it's pretty unique. It features an art gallery space with pedestrian access. The architecture would feature multiple tall triangular shaped peak roof lines to match the surrounding neighborhoods, all while ground floor retail doesn't all with ground floor retail on the bottom floor. So it doesn't work everywhere, but it does appear to work here. The developer has letters of intent or advanced pre-leases with a jewelry designer, a porcelain dinnerware retailer, Angel's Kitchen restaurant, an artistic curation and activation group called Open Projects, and a nonprofit called Design by Rhode Island that supports designers and design businesses in the state. As I mentioned, the project's located on land formerly occupied by the interstate before it was relocated. 150 apartments, 25 condos, and 50,000 square foot hub for designers and artists. It's a joint venture between Ionic Development and Wade Keating Architects. Now, I'm certainly not the creative type by any means, but I can certainly appreciate a unique project when I see one, and this one looks pretty cool. So thank you, Ian, for the tip. All right, back to our rental housing trivia question of the week. Which Southeast market saw the highest average apartment rent growth over the last 10 years? Was it Charleston, Knoxville, Miami, Naples, or Nashville? And the answer is Naples, Florida, averaging 6.7% since 2015. Now, in fairness, this one's kind of a trick question because Naples has been absurdly volatile, one of the most volatile apartment markets in the country over the last decade. So 6.7 is the average, but not really the norm, if that makes sense. This is one of those markets when it's hot, it's crazy hot. When it's cold, it's crazy cold. At the peak of inflation, Naples was seeing some wildly high double-digit rent increases, and obviously that's cooled off substantially. Over the last 18 months, though, rents have actually been falling due to high supply. Some other ones in the upper group for rent growth the last 10 years include Knoxville, Tampa, West Palm Beach, Sarasota, Savannah, Charleston, Greensboro, Orlando, and Fort Lauderdale. So kind of a mix of markets that have institutional interest and some that do not, but certainly all places that have been high demand and strong overall growth. And by the way, if you're thinking Nashville's a trendy pick, it's actually in the lower end of this list. Still solid, but average below 4% over the last decade, which is below Charlotte, Raleigh, most of Florida, and even Atlanta. Of course, ultra-high supply has played a big role there in compressing rent growth. Still hot demand market. It's going to be fine long-term, I'd think, especially in the suburbs where there's been a lot less supply pressure. All right, that's going to take us to the interview portion of today's podcast, and I am thrilled to welcome in James Kane, formerly the managing director and head of asset management for Starwood, headed up a portfolio of more than 85,000 units at peak, and today is heading up the Southeast as a partner for Madera Residential. So let's welcome in James Kane. All right, and welcome to the interview portion of today's podcast. And I am thrilled and honored to welcome in my friend, James Kane. So James is the Southeast partner for Madera Residential. James, thanks for being here.
Yeah, friend and colleague, Jay.
Friend and colleague.
Don't forget about that.
No, and I don't forget about it, but I will tell you, I don't know if you remember this. One of the first memories I have of you, James, and I didn't brace you for this story, but it was one of my old colleagues threw a house party, rented an Airbnb in northern Dallas somewhere. And it was
I don't like where this is going already, Jay.
It was one of the more awkward social events I've been to, but thankfully you were there, and we had a good time chatting. This is probably, I don't know, 10, 12 years ago, something like this. But
those were the days.
They were, but yeah, it was not the venue I would have picked for a corporate event, being in some random neighborhood in North Dallas, but we had a good time.
Yeah. Yeah. Well, here, look at us now.
Look at us now. Yeah. Now here we are.
You got a podcast, and we're colleagues.
And you're still wearing cool blazers.
I'm still wearing cool blazers.
All right. So going back to the old days, tell a story about how you ended up in multifamily.
Yeah, it was a lot of luck, but I think as Barry Stern used to say, that luck is where hard work meets opportunity. And it was really being in the right place at the right time with just a tremendous group of multifamily investment professionals at Starwood, that really kind of pushed me into the multifamily business. Started with Starwood in 2004 at a business school, and joined them. It was a smaller fund. There was really not a real focus on product types. It was a true opportunity fund. Worked on office buildings, worked on retail, had an active adult development, worked on a golf course investment, and then there was also some multifamily sprinkled in there. And I was fortunate enough within that small group of multifamily assets in the early 2000s to work with some really good GPs that Starwood had partnered with, one being a guy named Dan Gumbiter. And Dan was at Orion. We had some assets together, and he was really my multifamily mentor. Kind of taught me how to look at things the right way and how to value engineer things, and had some tough real estate that we carried into the GFC. We worked out a number of different loans, and it was a trial by fire. If you can imagine, the headcount got a little bit smaller during those times, so really had to lean on a really good base of GPs. And as we emerged out of the GFC, the value proposition to buy apartments got really attractive to Starwood, and I became the de facto multifamily guy. So started out with a portfolio of about 5,000 units coming out of the GFC, and by end of 2018, it was 104,000 units, and I had built out a full service investment management platform, covered assets from Seattle to Miami, and that was where my career trajectory took me.
Yeah, it's really amazing. I mean, thinking back to, as you just touched on, I mean, Starwood was one of the big players in the growth of the multifamily sector in the 2000s. You're one of the most key players at Starwood, going from 5,000 to more than, into the six figures. Really, I mean, those were the boom times in multifamily as a sector has became more of a favored class in institutional investments in commercial real estate. So, thinking back to that time, what was that like going through just so much growth between the GFC to, really that time around COVID?
Well, in a word, it was busy, but it was super exciting. And you didn't know where the next opportunity was going to come from. I think the first larger portfolio deal that was done out of the GFC was a portfolio of about 1,600 assets in Northern Virginia. And that kind of kickstarted the thesis to buy workforce housing in growth markets. And DC then, this was 2011, is a lot like DC is now. It's seeing growth where other markets hadn't. And I think I just remember DC is one of those markets that didn't have a big drop in rent growth during the GFC. So that was the first investment. A lot of it was Chris Graham, who is kind of the head of acquisitions over at Starwood. It was really his brainchild, the thesis, the architect behind buying workforce housing and in the Sun Belt really stemmed from him. I think he saw the increased demand coming out of the dislocation of home ownership in the GFC, saw the value of positive leverage, lack of supply that was present at that point as really nothing got built in the early stages of the recovery. So it was an exciting time. It was great for my frequent flyer account. That I can tell you.
Yeah. Yeah. And just looking back on them, it's remarkable. I mean, just the growth that went through there. I mean, when that all started, office was the predominant asset class in commercial real estate, and here we are, and apartments are the king. So,
Yeah, I mean, it really, the institutionalization of the product type was something that um, that happened pretty quickly. I remember this was end of 2015, early 2016, a large portfolio of assets north of a $5 billion transaction. Um, you know, 24,000 units, 60 some odd assets that we were in contract to buy. And I remember vividly sitting in San Francisco, going through 62 different closing statements and trying to tick and tie all of the prorations. And we were, trying to do the immaculate closing, right? So you close the debt and the JV equity from a co-invest fund that we raised, and closing all the real estate across multiple markets in one day. So we stayed up all night, just making sure everything ticked and tied. We woke up the next morning. These things tend to lag. Finally closed the portfolio. Didn't have time to celebrate. Immediately went to SFO, jumped on an airplane, flew to Denver to meet our new institutional partners. And these were not your normal institutional partners, Jay. These were Far East sovereign wealth funds who were making direct investments into apartments, and that was something that really opened my eyes when you looked at the possibility of how the product and the asset type can grow if you can attract that kind of capital.
Yeah. That was definitely a big change. All right, so fast forward a little bit. You turned some heads when you announced that you were going to join Madera Residential, and obviously you and Charlie Young, one of the founding partners, you've known each other a long time, done deals together. I think Charlie still owns some assets you sold to him from your Starwood days. So, but I mean, you've worked with a lot of people over your years, so you had plenty of options, I'm sure, when you're looking for the next stage of your career. So, why did you choose to work with Charlie and Madera?
Yeah, as you mentioned, when I was in Starwood, sold a handful of assets to Charlie and Madera, and I don't know, did hundreds of transactions. And you kind of remember the bad ones, you remember the good ones, and everything else is in between. And I remember the transaction with Charlie very well. It was a portfolio of assets, and 80s assets in Dallas, and maybe a sprinkling in Houston. And I can't tell you how many times you try to negotiate a purchase and sale agreement and you just get stuck on a few things. And it's always, well, what happens if there's, a fire or some major catastrophe at the building, and you spend time and lawyer dollars to get it done. It never happens. Well, this was the one instance where we actually had a fire, a pretty major fire. No one was hurt, luckily, but property damage done after the end of due diligence. And usually that would be full shutdown. Let's bring in the lawyers and the construction people, and it could potentially crater the entire deal. Charlie and I worked it out over 2 days.
Nice.
He brought his construction guy in. We had some construction resources. We gave him a credit for the cost to rebuild, and that was it. So everything that had been negotiated threw out the window, and let's just make this a win-win proposition for everybody. And it worked out great for him. It led to other opportunities with Starwood. And it just showed me the kind of person he is, the integrity, a guy that's going to say what he does, can see the bigger picture in terms of the relationships that exist in our industry. And we had conversations ongoing for the last couple of years, and I wanted him to get in the Southeast. He wasn't so much interested; just didn't feel like he knew value there. Didn't know the players, didn't know the markets as well. And I always said when I left Starwood, I would look for something that felt more entrepreneurial, a way to really kind of go in and roll your sleeves up and go asset by asset, and not to knock my experience at Starwood, but it was a large portfolio.
Yeah.
And it's really hard to really move the needle on an asset by asset basis with a portfolio that big. And I feel like that's where we are in this phase in the market. Everything feels really difficult to pencil. So you've got to be willing to go in and sharpshoot. And I think Charlie's probably one of the best snipers I've ever seen in terms of finding real estate.
Yeah, absolutely. He's a good dude. So you mentioned kind of that entrepreneurial time of Starwood to now kind of another, starting a more entrepreneurial role again. So do you see any parallels between those early and mid 2010s when buyers like Starwood and Blackstone got back into buying multifamily early, back when the conventional thinking, it's crazy to think about now, but there was a time people thought, even six caps didn't make sense.
Right.
And the conventional thinking was that deals didn't work. And now here we are in 2025. Are any parallels between these two periods?
A little bit. I would say a lot of the lack of investment activity coming out of the GFC was everyone was just scared. They didn't know.
Yeah.
No one knew the bottom. I remember hearing the phrase "catching a falling knife" so many times that it's kind of like etched into my brain. And I think the main difference that I'm seeing right now is even in 2011 and 2012, you had positive leverage. And that's because cap rates got to a point where you could still finance and get a decent amount of yield coming in the investment. And the way that Starwood, the way we looked at things in the early phases, if we feel like there's risk and you can de-risk that investment by getting a substantial portion of your return from cash flow, then you can miss on a few things in the underwriting, and you still have the safety of that cash flow. You also really didn't worry about expenses that much. I mean, you think about now, whether it's cost of insurance or what some of these municipalities are doing with taxes. That's something that is part of the due diligence that you just took for granted.
Mm-hmm.
I mean, insurance was $250 a door in most of these markets, and you didn't think twice about it. So when I look at the investment climate now, yes, there's a bit of fear. No one wants to get out early. I think in some cases people have been rewarded by going in earlier and finding good opportunities, but the growth and what people really need to have conviction to buy real estate hasn't happened. It's obviously the supply has overhung a little more than we all thought. And it just feels right now from an underwriting standpoint, you've got to be perfect. And if you're perfect, you're still getting a mid-teens return in most cases, and most of it's back end loaded. So I think if I can translate anything to what happened in the early days of coming out of the GFC and now, is that what we saw in 2013, 2014, in some cases a little bit earlier, is a tremendous amount of rent growth that nobody thought was going to happen. And it wasn't 2021 kind of rent growth,
right.
but you saw the benefits of a low supply time in the market where people were starting to see apartments as a viable option, and the demand came and the rent growth followed. And that's our thesis in the next 2 to 3 years is it's going to happen slowly. But when it does, when it finally catches, you're going to see a tremendous opportunity to see rent growth. And that's, if you want to look at your asymmetric risk in terms of apartments right now, I think you've got the opportunity to have higher rent growth than you would ever underwrite. And there's always the opportunity for cap rate compression, but that's a lever that people just aren't willing to pull right now.
Yeah. Yeah, you mentioned that low supply period. I still remember to this day. I read an article, a column by a banker, an American banker. It's probably 2011, 2012, and he was raising the alarm bell about, hey, there's more permitting happening for multifamily. This is a sign of a trouble, and it was like less than 200,000 units nationally or something. I mean, it was nothing back then. So,
I remember sitting in NMHC when they still had in Boca, and they put and this was 2009, maybe 2010. It was early on, and they were talking about the poster children for rent growth. It was Pittsburgh.
Yeah,
as like Pittsburgh is doing better than everybody else, and,
I remember that.
Why? Well, because nobody's building in Pittsburgh, and you had the usual suspects. I think it was Jacksonville and in Vegas and in Orlando and in Phoenix, the ones that got a little overheated, and
yeah, back then it was Vegas, Phoenix, and Florida got crushed.
Right. And look, I think the difference now is that everybody in some way, shape, or form, there are pockets in every market that feel very full right now.
Yeah.
And it will take time. But I mean, I keep telling people I've got a lot of developer friends. Like developers are not they're not dumb. They might be aggressive, but they're going to these places because they see the momentum in employment and job growth and the fact that it's business friendly. And they did what they like to do, which is build, and at some point they'll do it again. But I don't think they were wrong in where they targeted. They just
Yeah.
got a little exuberant.
Yeah, no, I absolutely agree. And so let's talk more about supply. And, Madera historically has been all Texas. One of your roles is to expand Madera into the Southeast. And as you know, whether it's Texas or the Southeast or Southwest, the knock has always been supply. And what we've seen is that throughout the 2010s, that wasn't nearly the boogeyman that the kind of haters would say. And we generally saw the Sunbelt markets outperformed, especially through COVID, but even before that. But now, 23, 24, probably 25, we're seeing what high supply, like truly a lot of supply, finally, for the first time we really see this, a lot of supply, the impact that really has. And it's probably a once in a generation peak wave in deliveries that's causing these challenges. So if you're putting going back to your days, heading up asset management, putting your asset manager hat on, how do you manage through that? Navigating through these short-term headwinds, well, banking on the growth story you talked about, business friendly, but job growth, population growth, migration, that long-term story of continued demand growth into the reduced supply environment.
Yeah, well, let's first talk about the product type as a whole and its resilience. It got through the GFC faster and stronger than anybody thought. It got through COVID faster and stronger than anybody thought. And now you've got supply. It continues to get battered, and it always comes out stronger on the backside. So I think some of it's just patience. But if I had to put my asset manager hat on, in some cases, you just got to throw the business plan out. Right? You've got to reset on where you are. If you're doing a lease up and it's stalled, and maybe for the last 2 years you thought you were going to sell it, so you tried to manage for a sale versus managing just to stabilize the real estate. Whenever we had this problem in my former portfolio, it's get the asset to a point where it's got a strong rent roll and it can see growth. And some of that is making sure you've got great resident satisfaction. I mean, the best thing you can do at a time where everyone's trying to grab your residents is make them happy.
Mm-hmm.
Get your work orders done. Go and do some minor things around the asset and the amenities that spruce it up. Make sure your front door and your landscaping is clean. I've never been a big fan of defensive renovations. Just renovating because you're afraid your rents are going to go down if you don't do something. I think renovations, especially interior renovations, should always be offensive.
Yeah.
There's little things you can do. You can go put a new appliance package in there because for the most part, those appliances are going to be reusable. But I think the best thing you can do is sit down with your property manager and listen to them and like, what are the challenges they're facing and try to fix that. If they're having challenges attracting people, try to flex some more money into marketing. If you're getting complaints about maintenance or something internal, then flex some maintenance people to clean it up, because nothing can impact an asset worse than having kind of a mass exodus of people leaving at a time where you're struggling to close traffic because of other opportunities.
Yeah, absolutely. So let's drill more into the Southeast, where you're looking to expand. What markets across the Southeast region do you like right now?
It's a pretty tough question given all the supply chatter we've already had, Jay. I mean,
Yeah.
Again, you can
through the next cycle.
Look at.
Yeah.
How long is that going to be? We're talking like the last cycle, or is 10 or 15 years? I like everything. Just buy it now. Wait for cap rates to come in.
There you go.
No, I think you have to be mindful of supply, right? You can't pretend it's not there. You can see it in the rent rolls of everything that you look at of what the impact of that supply is. Atlanta is kind of on the back end of that. So I'm starting to see in some of the deals I'm looking at some positive momentum in terms of lease trade out. not massive, but starting to see 1, 2, 3% on new leasing. And this is historically the start of a stronger leasing period. So over the next 3 or 4 months, if that trend continues, that's a great sign. And when you look at the Carolinas, the supply pipeline there is very robust, and as I talked about, there's a reason. It's a great quality of life.
Yeah.
It's attracting jobs, attracting diverse jobs. Great kind of eds and meds relationship across all those major markets. But yeah, if I have to give you an idea of what within those markets, what's interesting to me, it's really the concept of placemaking, and that can be in two different ways. I've seen in Atlanta and the Carolinas and some other markets, this revitalization of the small town downtown. So you have a main street that maybe didn't have the kind of retail that attracted today's resident. Well, now it's got chef-driven restaurants, and it's got breweries, and it's got really a sense of place. So if you can find assets that are proximate to that, people don't have to go into, a city center, like the Woodstocks of the world, the Alpharettas, the Roswells, Duluth, like Matthews and Charlotte, Holly Springs, like places that are quaint, that give you a sense of place. And those are usually in some of the further out suburban nodes, that have really been rediscoveries over the last 5 to 7 years.
Yeah.
The other thing, which is where we're seeing the bulk of the supply, are some of these new markets that kind of sprung up over the last 5 years, 10 years that are really interesting now. So West Midtown in Atlanta, obviously the Beltline in Atlanta, and what that's done to drive demand and traffic, and South End and Noda and Charlotte. They are ripe with supply, but what all that supply is going to do, it's going to add the vibrance to those markets.
Yeah, downtown
It's going
Nashville,
to
same
add
thing.
street level retail, the Gulch in Nashville. You have to kind of believe that over time that people are going to be attracted to the amenities. Sure, they want a nice place to live, and they want to feel like they're getting it at a good price. But at the end of the day, they want to be proud of where they live and see the opportunities. And the old adage that it still works. I mean, if you're targeting good schools, good access to transportation, that stuff all works. But I think today's renter, where we used to really focus on the families, because that we felt like that was the stickiest renter. If you got somebody in there and you had a good school district, you could keep them. I think if you have assets in good nodes, and you treat people the right way, they'll want to stay because they're there because of the amenity base.
Yeah, absolutely. Yeah, all great points, man. I mean, the demand story. We just had population growth numbers come out this a couple weeks ago, and for 2024, and you still see it's come. It's funny. I see these narratives about, hey, growth has really slowed down in the Carolinas and Florida and Texas and Tennessee. And you look at it's like, hey, it's not the crazy numbers we saw during the COVID years, but these are still growing markets. I mean, the Floridas, the Carolinas, the Charlottes, the Raleighs, the Nashvilles, even the smaller markets, the Charlestons, the Greenvilles, the Wilmingtons, like they're still growing really well. A good growth story. So that demand's there. Any just out of curiosity, I mean, what we've seen some of the faster growing areas in South Carolina, is that on your radar at all? The Greenville, Charleston story?
Yeah, I mean, Charleston, I love. Charleston's it's such a cool market. I have a hard time wrapping my arms around the demand drivers there, other than that people want to live there. It's a great quality of life.
Graystar employees.
And Graystar employees, and I guess people that work for Boeing, whatever they're going to be. But it's got the coolness factor. It's still a relatively small market. It's great. Greenville is the downtown, about like downtowns that have revitalized. Greenville has that in spades. For me, I'd rather focus on the major markets, but we're keeping an eye on all of those places. And we're not anti-Florida right now. It's we're trying to focus on the southeast markets
Yeah.
that we feel comfortable with. The
I want to ask
insurance
you about
issue is
Florida in
still,
a second, but before we get to
yeah,
Florida, also we didn't talk about Tennessee at all much, but you mentioned the Gulch, but also when I think about like cool suburban, like revitalizing areas, I mean, like Franklin, Tennessee
yeah,
is definitely up there as well. Nashville, you like that market?
yeah. I love Nashville. It's so my partner in crime, Charlie. We because he's the Texas guy, we try to compare and contrast Nashville and Austin, and they're very similar. Where if you're there and you spend time there, you get it,
Yeah,
and it's cool. But they're still relatively small markets compared to
absolutely.
the Charlottes and the Atlantas and the Dallases and the Houstons. So I think you have to pick and choose your opportunities. Um, Certainly there's a lot going on in Nashville around the waterfront, with what Oracle is doing with the stadium redevelopment. You've got some corporate reloads that have happened there. It's not as institutional of a market
Yeah,
as I think it needs to be.
right.
Um, and I think that'll benefit people like us that want to come in early, are willing to take bets. But I mean, the assets that I've seen there that are interesting, they're they're getting quite a robust bid. But we're definitely tracking Nashville. Probably not tracking Memphis as much.
Yeah, well, Memphis is a whole different market, right? But it's interesting. You're pointing about institutional. Like, it's funny. Like, you go to the the NMHCs and all the other events, like Nashville, and you see this in the the sales to comps data and buyers. Nashville was really not on the institutional radar until 5-10 years ago, versus
Yeah.
Charlotte and Raleigh. Obviously, were there a lot earlier, but it's certainly there now. It's catching up.
Yeah, I mean, I think they just didn't have what we would all refer to as institutional product.
Yeah.
And they fixed that in a big way with the high rise, mid rise,
Yep.
down in the Gulch. And Germantown has always been a little node in what they're doing with the connectivity, into what is going to be the other side of the river with Oracle. There's a lot to like,
Yeah.
for sure.
So let's go back to Florida. You mentioned that, I cut you off, but Florida, there's not a demand side issue. I mean, the population growth has been. I mean, Florida's a
It's great.
top market in the country, better than Texas and the Carolinas and Tennessee for population growth. Obviously, got a pro business climate. But insurance has cast a big shadow, property taxes. So how do you think about Florida right now relative to your other options?
Yeah, I think if we found something in Florida that we felt was can't miss, we don't have a problem going in there. We just don't want to spread ourselves too thin. We want to be experts in the markets where we operate.
Yeah.
We want to be able to find the opportunities, and like Florida is a new animal. All right, it's you've got Jacksonville, you've got Orlando, you've got Tampa. South Florida is really three different markets. So
Yep.
you can say going into Florida, but you're really going into 5, 6, or 7 distinct markets, and it's a very active. I love parts of Tampa. The suburban nodes of Orlando
Yeah.
feel really good. I mean, they all have similar issues in terms of supply, and I think that'll be something that, as we get ramped up and can prove out the theory that we can move our investor base into the Southeast, I think the natural progression is to flex down to Florida.
Yeah, that's a great point about the different markets. I mean, even like Southwest Florida is now institutionally of interest.
Right.
Fort Myers, Sarasota, Naples, that whole area.
And I spent a lot of time in my former life, in South Florida proper. One, it takes you the better part of 2 hours to go from Dade up to Palm Beach, and each one of those markets, Palm Beach, Broward, and Dade, all operate very differently. One in the quality and who your resident is. Some of the job drivers. So again, I don't want to go in and say we cover Florida, and next thing you know, we're spending the time running around to all parts of the state.
Yeah.
It'll come.
Yeah.
Give us time.
Absolutely. All right. Well, James, appreciate your time today, and looking forward to going into the Southeast together.
Well, boy, I can't wait to trot you around to all of our investment partners.
All right,
Jay. We look forward to that.
All right. Let's do it. All right. Well, thanks so much,
All right.
James. that's a wrap on episode number 28 of The Rent Roll. Big thanks to James for joining us, talking the Southeast. Big thanks again to JPI and Madera Residential for sponsoring The Rent Roll. And thank you to all of you for making this part of your week. We'll see you next week.